Nike is making headlines again. After a rocky stretch marked by supply chain challenges, shifting consumer demand, and fierce competition, the sportswear giant is showing signs of a rebound. Sales are ticking up, its brand remains one of the strongest in the world, and new product launches are drawing attention. But there's a new storm on the horizon: tariffs. As the US expands trade restrictions, Nike's global supply chain is directly in the crosshairs. That raises a big question. Can Nike's margins survive the pressure, or will tariffs undercut its rebound? Let's break it down. First, the rebound story. Nike has been through a tough couple of years. Pandemic disruptions hit production hard, especially in Asia, where many of its factories are located. At the same time, consumer spending shifted during inflationary spikes, and competition from brands like Adidas, Puma, and fast-growing upstarts cut into market share. Now, Nike is fighting back. It has streamlined its operations, invested heavily in direct-to-consumer sales, and leaned into e-commerce channels. Digital sales are growing, and Nike continues to dominate in key markets like North America and China. On top of that, it's rolling out new products, from lifestyle sneakers to performance gear, that are resonating with both athletes and fashion-conscious consumers. So the rebound is real. But it comes at a fragile moment. Enter tariffs. The US has already slapped new tariffs on furniture, heavy trucks, and pharmaceuticals, and trade officials have signaled that apparel and footwear could be next. That's a problem for Nike because its supply chain is deeply global. A significant share of Nike shoes and apparel are manufactured in countries like Vietnam, China, and Indonesia. If tariffs are imposed on imports from these regions, Nike's costs could surge. The math is simple. Higher import costs squeeze profit margins. Nike can either absorb those costs, which cuts into earnings, or pass them on to consumers, which risks dampening demand. Neither option is ideal. Now, Nike has been here before. During past tariff disputes, the company lobbied hard against trade restrictions, arguing that duties on footwear and apparel effectively act as a tax on American consumers. At the same time, Nike has been diversifying its supply chain, moving some production out of China into other parts of Asia. But diversification takes time, and no matter where Nike manufactures, much of its output still has to cross borders. This leaves Nike with a tough balancing act. On one side, it's trying to maintain momentum in its rebound, driving innovation, building hype around new releases, and expanding digital sales. On the other side, it's bracing for potential cost pressures that could erode profitability. For investors, the stakes are high. Nike's stock has historically been seen as a strong growth play, thanks to its brand power and global reach. But if margins weaken under tariff pressure, investor confidence could wobble. That's why analysts are watching closely, not just at sales growth, but at how efficiently Nike can protect its bottom line. For competitors, Nike's challenge could be an opportunity. Smaller or more agile brands that rely less on global supply chains or that produce more domestically may be able to position themselves as cheaper or more reliable alternatives. If Nike has to raise prices, some consumers may shift to rival brands. And for consumers, tariffs could mean higher prices on sneakers and sportswear. Nike products are already premium priced compared to many competitors. If tariffs push them even higher, price-sensitive customers may scale back, especially during a period of weaker consumer confidence. So how can Nike navigate this storm? One strategy is continued supply chain diversification. Expanding production in countries less likely to face tariffs or nearshoring some manufacturing closer to the US could reduce exposure. Another is focusing even more on direct-to-consumer sales. By cutting out middlemen and selling directly through Nike's own platforms, the company can protect margins better than if it relies heavily on wholesale partners. Nike can also lean on its brand strength. Few companies in the world have the same level of cultural influence. Limited releases, collaborations, and brand loyalty give Nike more pricing power than most. That means it may be able to pass on some of the tariff costs without losing as many customers. Finally, innovation remains key. If Nike can keep creating must-have products, whether it's cutting-edge performance shoes or fashion-driven releases, consumers may be willing to pay a premium even in a tougher economic environment. The bigger picture here goes beyond Nike. The story reflects the broader challenge facing global companies in a world of rising trade barriers. Brands that built their businesses on sprawling international supply chains now face higher risks. The winners will be those that adapt fastest, balancing cost control with brand strength. For Nike, the next year could determine whether its rebound turns into a full recovery, or whether tariffs stall the momentum. If the company can protect margins, leverage its brand power, and stay ahead of consumer trends, it has the tools to weather the storm. But if tariffs bite deep and consumer demand weakens, even a giant like Nike could feel the squeeze. The bottom line, Nike is rebounding, but tariffs threaten to trip up the comeback. Whether its margins survive will depend on how well it adapts its supply chain, pricing, and strategy in a world where trade barriers are the new reality.